Welcome to vTalkInsight, Risk Sentiment Daily for February 19th, 2026. Equities are leaning back toward risk-on, helped by resilient growth and broadening leadership, even as a more hawkish Federal Reserve tone and concerns about an AI capex bubble keep volatility supported. Let's unpack what is driving today's cautiously bullish backdrop. Risk sentiment has shifted back toward cautiously bullish territory. After several sessions with a defensive tilt, stronger macro data and broadening equity participation are allowing markets to absorb policy and geopolitical noise without tipping into full risk-off. U.S. equities are higher, with the S&P 500 up over 0.5% and volatility gauges sitting just under the 20 level, signaling that investors are willing to take risk again but remain sensitive to shocks. The macro backdrop is doing much of the heavy lifting. U.S. inflation remains contained around 2.4% even after tariffs. Real wages are reported to have risen by roughly $1,400 over the past year, and productivity growth near 3% supports estimates of aggregate supply expanding closer to 5%. Industrial production, business equipment orders, and housing starts all point to solid fourth quarter GDP, while S&P 500 companies have delivered 5 consecutive quarters of double-digit earnings growth and record margins. That combination underpins the soft landing narrative and explains why investor sentiment is the most optimistic since 2021. At the same time, there are visible cracks beneath the surface. Middle-income U.S. households are seeing slower spending, credit stress indicators are projected to reach historic highs, and UK unemployment, especially among younger workers, is rising. So the aggregate data looks strong, but the distribution of that strength is uneven. Cross-asset flows are consistent with this cautiously bullish stance. Investment-grade credit remains well bid, with large issuance from names like Alphabet absorbed easily, and equity leadership is broadening into cyclicals, basic resources, and non-U.S. markets. However, 3 risk clusters continue to cap enthusiasm. First, a hawkish shift in Federal Reserve communication has pushed Treasury yields off their year-to-date lows and raised doubts about the pace of rate cuts. Second, mounting concern about an AI capex bubble is weighing on parts of technology, particularly software and data center exposed names. Third, geopolitical tensions from Ukraine to the Persian Gulf, together with political interference risks around European central banks, are keeping a residual risk premium in energy and European assets. Against this backdrop, today's mood is not euphoric, but it is constructive. The key question is whether resilient growth, selective central bank easing, and broader equity rotation can continue to offset these downside risks. The strongest bullish force today is the resilient growth and soft landing narrative. U.S. inflation running near 2.4% despite tariffs, combined with rising real wages and productivity near 3%, suggests the economy is expanding without reigniting runaway price pressures. Recent data back that up. Industrial production and business equipment orders have surprised on the upside, housing starts are at a 5-month high, and core capital goods orders are still rising. On the corporate side, margins are at record levels and S&P 500 earnings have grown at double-digit rates for 5 straight quarters, while some strategists see room for the index to grind about 10% higher by year-end. This macro resilience is feeding directly into risk assets. Investor surveys show sentiment at its most bullish since 2021, anchored in expectations of strong profit growth and a global soft landing. Policy support for U.S. manufacturing, including tax incentives and AI-enabled automation, is drawing capital into sectors from autos and appliances to defense, reinforcing the growth story. But the soft landing is not guaranteed. Middle-income U.S. consumers face mounting affordability pressures and rising debt stress, and in the UK, a weakening labor market hints at future demand headwinds. Tariffs remain a drag, with studies indicating that most of the burden falls on U.S. firms and households. The takeaway is that the top-down growth picture is robust, yet pockets of vulnerability could matter if the cycle turns, which is why markets are so focused on the path of policy rather than growth alone. Selective central bank easing hopes are the second key bullish driver, led by the Bank of England. UK inflation has fallen to its lowest level since last March and is widely expected to hit the 2% target by April, helped by government measures and favorable base effects. Markets now price roughly a 75% probability of a bow rate cut as soon as March, and some forecasts see cumulative cuts of about 75 basis points in 2026, more than current market pricing. Softer wage and labor data have already triggered a rally in gilts, with yields moving lower as investors lean into a more dovish bow stance even as parts of services inflation remain sticky. In the U.S., easing expectations are more contested but still present. Some projections continue to look for 3 Federal Reserve cuts this year, citing softening inflation and mixed labor market indicators, and these expectations help anchor risk assets despite recent volatility. However, the emphasis is on the word selective. UK disinflation looks more straightforward than in the US, and both economies face lingering services and tariff-related price pressures. Several analysts warn that markets may be underestimating the persistence of UK inflation and the level of the eventual terminal rate, while Fed officials have clearly raised the bar for cutting. For portfolios, this means easing remains a support, but one that is region-specific and highly data-dependent rather than a blanket global tailwind. A third bullish driver is the broader global equity rotation and AI upside beyond the US megacaps. Market breadth has improved meaningfully, with roughly 2/3 of S&P 500 constituents now in uptrends, reducing reliance on the so-called Magnificent Seven. In Europe, basic resources and banks are leading gains, with basic resources up around 1.5% to 2% and banks also advancing. The FTSE 100 and other European indices are attracting flows thanks to their commodity and cyclical exposure, which are seen as relatively insulated from the most intense AI valuation swings. At the same time, the global AI supply chain is driving powerful regional and sector rotation. Asian semiconductor leaders in Taiwan and South Korea are growing AI-related exports rapidly, with some firms gaining market share at rates approaching 80 to 90%, and Taiwan's chip exports up about 30% this year. Portfolio tilts toward hardware, semiconductors, and Asian equities have been in place for over a year, and have been rewarded as South Korean equities returned over 90% last year and continue to outperform. Industrial demand for silver, used in AI data centers, advanced semiconductors, and solar, is accelerating against constrained mine supply, while generalist investors are adding exposure to precious metals and European basic resources. Together, these trends signal a healthier, more globally diversified equity advance, even as they increase dispersion between winners and laggards. On the bearish side, hawkish Fed tone and rate uncertainty are front and center. Recent minutes show that while most officials still expect disinflation to continue, they see progress toward the 2% target as slower and more volatile, with meaningful upside risks. A minority on the committee is now openly discussing the possibility of renewed rate hikes if inflation pressure persists, the first time in years that hikes have been back on the table. Fed commentary has also emphasized high asset valuations, concentrated equity gains in a handful of AI names, and rising leverage in hedge funds and private credit, all of which argue for caution in loosening policy prematurely. This shift in tone has real market consequences. U.S. Treasury yields have backed up from year-to-date lows, with the 10-year note moving to just over 4%, and equities sold off immediately after the minutes as markets reassess the timing and depth of cuts. There is also a broader debate about AI-driven capex and productivity potentially pushing the neutral rate higher, limiting how far policy can ease without restoking inflation. Internal dissent on the timing of cuts and repeated signals that more evidence is needed before easing increase path uncertainty for both rates and risk assets. For allocators, the risk is less about whether cuts eventually arrive and more about the volatility around that path, particularly for duration-sensitive growth equities and leveraged credit. A second major headwind is concern about an AI capex bubble and tech fragility. Hyperscalers are planning around $650 billion of AI-related capital expenditure, raising questions about whether current power infrastructure can support that build-out and drawing explicit comparisons to the telecom overbuild of the early 2000s. Analysts describe the U.S. AI sector as in a capex bubble, with investment running ahead of infrastructure and power capacity, and warn that excess data center capacity could become a drag through depreciation and lower returns. Hardware supply constraints and shortages in DRAM and hard drives are pushing component prices higher, squeezing smaller firms and pressuring margins at companies that cannot pass on those costs. The equity impact is already visible. The S&P Software Index is down about 20% year-to-date, its deepest underperformance versus the market since 2000, as investors grapple with AI disruption, disappointing guidance, and complex acquisition strategies, exemplified by the sharp sell-off in Palo Alto Networks after a weaker outlook. There is also growing uncertainty around long-term terminal values in AI-exposed sectors, leading to structurally higher volatility premiums, even though options markets have not fully repriced that risk. At the same time, fundamentals are not uniformly weak. NVIDIA's new Blackwell chips promise dramatic efficiency gains. Meta has committed to deploying millions of NVIDIA processors that could generate over $16 billion in revenue, and technology earnings revisions have outpaced the broader S&P 500 by a factor of 3 over the past 4 months. The result is a fragile equilibrium where strong AI winners coexist with mounting bubble fears, leaving tech-heavy portfolios highly sensitive to any disappointment. The third bearish driver is persistent geopolitical and central bank political risk. On the energy side, progress in U.S.-Iran nuclear talks has pushed oil prices sharply lower as markets factor in the possibility of sanctions relief and reduced Middle East supply risk. But that optimism is fragile. Negotiations have only advanced modestly, significant gaps remain, and a sizable U.S. military buildup in the Persian Gulf underscores the risk of escalation that could send oil prices spiking in the other direction. In Europe, peace talks between Russia and Ukraine show little real progress, with economic pressure mounting on Russia, but no clear path to a settlement, keeping regional uncertainty elevated. Overlaying this is rising political risk around European central banks. Speculation that Christine Lagarde may step down early as ECB president has intensified, with potential successors seen as more hawkish and board appointments expected to be contentious as major member states jostle for influence. At the same time, debates in the UK about altering the Bank of England's mandate and broader questions about central bank independence in Europe and the UK are gaining traction. A more hawkish ECB leadership could support the euro but weigh on risk assets if markets price a more restrictive stance, while visible political interference could prompt higher risk premia in both rates and foreign exchange. For global portfolios, these overlapping geopolitical and political dynamics are less about day-to-day moves and more about background risks that can suddenly reprice energy, European assets, and safe havens. To sum up, today's backdrop is cautiously risk-on. Resilient growth and a convincing soft landing story, selective easing hopes around the Bank of England and parts of the Fed curve, and a broader global equity rotation into cyclicals and the AI supply chain are providing solid support for risk assets. Set against that are a more hawkish Federal Reserve and higher for longer rate risk, mounting concerns about an AI capex bubble and technology fragility, and a persistent layer of geopolitical and political uncertainty around energy markets and European central banks. Watching how upcoming data, central bank communication, and AI investment plans evolve relative to these risks will be key for assessing where volatility and risk premium move next. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.